Good morning, everyone. And I want to welcome you to the lecture on the earnings per share. Earnings per share is actually something that is part of ratios, investors' ratios. And most of the time in your exams, it is isolated and tested for 5 marks. Yeah, most times. Earnings per share is actually having nothing to do with typical financial reporting stuff in terms of it being a standard, but you will need to understand it as part of your financial statement evaluation. That is the interpretation side. And another thing I need to point out is that this thing is pure mathematics, all right? So you don't need to really know accounting to do this. It's pure mathematics. It's with formulas, you fix in the items in the formulas, then you are good to go. So that is EPS. That is EPS for you. All right. Now, under this topic, how we are going to tackle it is that we are going to, it has two angles. We have on one side, basic EPS. And on another side, we'll be looking at diluted EPS. Most of the time called DEPS. All right. Now, under the basic EPS, we are going to look at it from the angle of full market issue. We will also look at where there is a bonus issue. And we will also look at where there is a right issue. Okay, so that is that. Under dilution, we are going to go through and look at convertibles. Convertibles are instances where you have a debt instrument that can be converted into equity instrument. Okay, so those are the instances where diluted EPS come in. All right, so we are going to look at that. So we look at convertible instruments. Then the next thing that we will look at is actually options. All right, options and warranties. Okay, options and warranties or warranties. To subscribe shares. So that is basically what we are going to look at. That is what we are going to look at. Now, essentially, we will actually, there is nothing like you are going to do recognition, you are going to do measurements or anything. Everything we are doing is probably measurements, and that's all. So what we will be looking at here is trying to define the concepts. All right, so that is what we'll be looking at. Define the concepts. And we are going to actually go ahead and do the calculations. All right, and the last thing probably we are going to do is to look at the presentation. All right, the standard requirement for presentation and disclosures. And the last thing we will talk about is the importance of EPS. All right, so this is our outlook and the things that we are going to tackle. Okay, so stay with me. Let's pick them one by one. Thank you. All right. So let's talk about basic EPS. But before that, let me just go back. Let me come back and point out some little issue. What I want to point out is that number one, when we are doing IAS 33 earnings per share, what we are looking at is that we are looking at companies whose shares are traded publicly, because it is in a public entity where you actually see any consolidated financial statements being published. Okay, then you will see that we can actually get the figures to conduct our earnings per share. All right, most of these days, they actually publish the financial statements with even the earnings per share. So we say that earnings per share here is for publicly trading entities. And as such, when we say earnings per share, what we are trying to say is that the attributable profits earned by each ordinary share. All right, so that is what we mean. Earnings per share should actually show us how much our share has been earned as, but I mean, it is out of it that they will pay dividends. Okay, so if your earnings per share is say 5 cedi per share, and the company pays you 3 cedis per share, then it means that the company is actually retaining in their retained earnings the 2 cedi per share. All right, so that is either they give it all out to you for your EPS, they give all your earnings per share to you as dividend, or they keep some. All right, so that is that. Let's now go back and look at our basic EPS. Our basic EPS. Basic EPS. All right. What you need to understand here is that basic EPS is the earnings formula, it's earnings per share. So we need to know the earnings, And when we say earnings, we are talking about profits. But the earnings or the profit here is those one after tax and ordinary and preferential dividend, all right? And preferential. Okay, Now, once we are able to get our profit after tax and deducted any preference share, then we now divide it by the number of shares. So we call it weighted average number of ordinary shares in issue. All right. So that is that. You need to know this formula offhand because it is not given to you in your exams. All right. So that is what you should know. Now, if you are doing this thing for a consolidated financial statement, then you need to understand that if you are going to go through, you have to find the group profit after tax. Okay. So here in terms of a group, what you are going to do, if you are doing a group EPS in a consolidated financial statement, what you're going to go through is to find a group profit after tax. And instead of preference share dividend, you will also less. Okay, so this one is minus, all right? Because the tax you are lessing from the profit. So you also lessen preference share dividend. Here too, you take the group profit after tax, then you less the non-controlling interest, the NCI, share of profit, and also less any preference share dividend. Okay. Because at the end of the day, what we want to know is those that are left for the ordinary shares people. Then you divide it by the weighted average number of ordinary shares in issue during the period, all right? Okay, so these are the formulas. They are pure knowledge base, and you need to understand these formulas. Okay, so that is that. It's as simple as this. So all you need to know is to find the elements of the formula and slot it in. You are so good to go. All right. Now, what we need to know is to go into the figures and try how we're looking at. Now, here, one, we spoke about at shares, when shares are issued at full market price. So that is what we are going to look at first. Now, what you see is that in a full market price concept, the earnings will be apportioned over the weighted average number of equity share capital. Okay, so it means that the key thing you need to know is that you need to take into account the date of the new share and do some of apportionment. All right. So note, the key thing you need to know is you will have to take into account the date of any new shares, issue or new shares, issue or new share capital, whichever way you call it. new share capital. So the important thing is that after you've taken note of that, you are going to actually apportion the earnings. Apportion the earnings over the weighted average equity share capital. So it means that key here is that you have to take note of the date, all right? Take note of the date we are talking about. Okay, so let's look at how the computation looks like, all right? So that is full market. So let's go and look at how the figures, when figures are present. All right. So let's look at this example. Let's look at this example. Okay, so we've been told that an entity has 200,000 shares at full market price. So that is the key. That is the key. At full market price. And the date, we've been told to take into account the date. And the date is what? 1st July 2018. 1st July 2018. All right. Now, what we need to go through and do is to check the other relevant information. They said that profit attributable to ordinary shareholders for the year ended 31st December 2018 and 2017 are given as follows. And the number of ordinary shares as at 31st December and this year's are as follows. Now we are asked to calculate the basic EPS for 2017 and 2018. So what we need to do now is to set up our date. So we have 2018 and we have 2017. We know that basic EPS is given by profit after tax and preference share dividend divided by weighted average number of ordinary shares in issue during the period. So during the period of 2017, we just need to go through and conduct our basic EPS. So looking at 2017, we have here the profit attributable. So it's straight profit attributable. So we can now show some workings here for 2017 and take our profit attributable, which we see here as 460,000. Then we now need to go through and divide it by the number of ordinary shares in issue as of that period is 800,000 shares. At the end of the day, what we get for our EPS is that if you take your calculator and you punch 460,000 over 480, what you're going to get is 57.5 cedis per share. All right, per share. So we can come in here and slot in our basic EPS, which is 57.5 per share. Like I said, you just need to know your formula and now slot in the elements. All right, so that is that. Now let's look at the EPS for 2018. Now in 2018, you could see that the profit has increased and the number of shares have increased. And remember, what we were told is that when we are doing full market price, we need to take note of the dates of issue of new shares. All right, so it means that as of January 1, 2018, the number of shares that we actually had, right, was what, 800,000. That is the number of shares that we have. Because the closing balance of this ordinary number of shares is what we will actually begin our new year with. Now, looking at the end, they said that as at the end of the day, we had 1 million. All right. And that one would tell us that if that is the case, and we are also told here that the new share of 200,000 that came to add up to this 800,000 to give us 1 million was actually happened at this. So in a sense, our 800,000 actually happened for just 6 months, but this one is 1st July. And remember, we are told we need to take note of the date and apportion the earnings over the shares as such. All right, so please take note of that as such. All right, so it means that that is the period then from July 1, 2018, there was an addition. All right, July 1, 2018, there was an addition of new shares. All right, so it means that we had 200,000 shares. What we need to understand is that, so as of July, we actually had 1 million shares. And this 1 million now continued from July to the end of December, which also gives us 6 months. So we need to weight it as such. All right. Now, if you weight 800,000 into, you have to get what, 400,000. Okay. Now, if you weight 1 million, it means you have to get 500,000 as you. At the end of the day, the weighted average is actually 900,000, not the 1 million. All right. So what you need to go through and do is, now that you found your weighted average number of ordinary shares, you can now pick up your earnings and slot it in. So you have your basic EPS at full market, giving you 550,000 all over 900,000. And we are ending up having how much? 61.1 cedis per share. All right, so that is it. The key here is that you need to weight. You need to weight the number of period that your asset, your shares at every given point in time spent during the year. So you see that we had 800,000 shares up until there was a new issue of 200,000 shares. Take note of that. So it means that in 2018, what happened was that we have 800 shares up to 1st July, it was still 800 shares. So technically, we had 800,000 shares. All right, that is what we had up to July. Okay, now from July coming, our share number was increased by 200,000, making it 1 million. All right, so that is how you weight it. All right, at full market. Please take note of that. Very, very important. Very important. All right. And they are stated clearly here that we said take into account the date of any new share, all right, and apportion over the weighted average. So please take note of that. So anytime it is at full market, then it means that you need to take into account the date and weight it. All right. Very important. Okay, so let's pick another illustration and see how we can deal with it. So that is what you see here. Let's look at this illustration too. Let's look at this illustration too. So what you see here is that this one actually presents a way you have to compute your profit after tax. So straight away, let me guide you here. You see, Felicity Co. Is a company with a called and paid up capital of ordinary shares, right? I need to take note of that at 1 Ghana cedi, and 20,000 redeemable preference share at 1 Ghana cedi each. They've given you the gross profit and they've given you the trading expense. They've also said that Felicity Co. paid the required preference share dividend and ordinary share. This is what they paid. The tax charge for the year was 40,000. What we are interested in is to find two things: our earnings attributable to ordinary shares. And how do we get that? We get that by taking the earnings after tax and taking off any preference dividend that has been paid. So you could see clearly, and also we need to find the weighted average number of ordinary shares. All right. Here there hasn't been any new shares as at this into this question. So it means that we have 100,000. There hasn't been any new shares. So you need to see as it has been presented to you over here. So you need to go through and determine. So you have your gross profit. You take off your expense and the preference share dividend. All right. Then you get your profit after before tax. You take off your tax. Then you now end up with your profit attributable to ordinary share. You take that one, you divide it by the weighted average number of ordinary shares, which was 100,000. Then you now get your basic EPS. All right. There wasn't any new share, and so it means that the 100,000 number of shares will run throughout the period. All right. So simple as that. It's very, very simple. So what I need to do here is to try and probably let you solve more examples under full market. So let's see if we can get additional ones to deal with. All right, at the end, some yet. So let me see if you can go through and do this. Let's say a company, say Ansaco, has earnings for the year the year ended, say 31st December 2021 to be, say, 2 point. Right, and Sako will start earning these monies very soon. So you have this. Then on, say, 1st January, say 2021, issued share capital was, say, 8.280 million. Ordinary shares, which is priced at 1 cedi each. And let's say Ansa Company now issued additional 3.312 million shares at full market price, full market value of, say, of this number on, say, 30th June 2021. You are asked to calculate the EPS. All right, for the year 2021. And what you need to go through and do is to stick out your formula and say that your basic EPS is given by profit after tax minus preference share dividend divided by your weighted average number of ordinary share in issue during the period. The period here we mean is 2021, which we are asked to solve this question. All right. So we need to find our profit after tax. Herein, what we see here is that our profit after tax is given to us here as the earnings for the year. We now need to go through and slot it in, having our 2.208. All right. Now we need to find the next thing, which is the weighted average number of ordinary share. And remember, we are told to weight it as per the date. All right. So what you see here is that as at 1st January, the number of shares that were there was 8.28. All right. That was there as at 1st January. And we are told that he issued these ones at full market. The reason why we are waiting at this date. So what we need to go through and do is to slot in a small table, which will have our date, which will have the number of shares, we have our year fraction, then we can get our total. All right, so what we need to set up and do is that as at 1st January 2018, all right, we have a brought forward of, we had a brought forward of the number of shares we had as at the time is this. So we have 8.2 million shares. Okay, and this one was there so we had to issue a new one. Okay, so that is what you see there. So it means that this one spent how many months? 6/12. Now, if you need to weight this with 6/12, then you're going to get 4140 million number of shares. All right, 4.14 million number of shares. All right, then we are told that there was new shares that were issued, okay, on 30th June. That one means that if you now add our new shares we have here, which is 3312, what is going to happen is that as at this date of 30th June, sorry, the year in question is actually 2021. As at 2021, our share had increased, all right? So what happened is that we add it up. We are having 11, 5, 9, 2 million. And these ones also spent up to December, being 6 months. We now weight it and we have 5796 over here. If we add it together, what are we getting? We will have 9936. Now we now need to come and slot our figure into our formula and have 9936,000, which will give us EPS of what we're going to get is 22.2 pesos per share. All right, so that gives us a key understanding here is that when it's a full market, you need to actually go through and weight your ordinary shares by determining how many months in the year each share spent. All right, so before the new issue, we had this one spending 6 months. All right, when we added the new one that we issued, the total of it also spent 6 months. Don't be mistaken to do this one over multiply by 6/12 and go on to do this one 2 over 6/12. No, it didn't happen like that. In a sense, probably what you can do is to know that this one spent the full year, all right, and this one probably spent half year. But in weighting, this is the proper way to go. All right, so this one spent 6 months. We all know that is from here, this date to this date, 6 months. All right, then on that same day, there was new ones added. So when you add it to the existing ones, all of the remaining, the balance or your total now spent additional 6 months. All right, so that is it for basic EPS at full market. All right, we now need to go through and tackle the other side, which is when there is what? A bonus issue. When there is a bonus issue. Now, one thing you need to understand is that anytime there was an issue and cash is generated, you have to present a weighted average table. All right, like the way I did. You have your date, you have your number of shares, your fraction. All right, then you have your total. That is the pro forma weighted average table. You have to set it up all the time. All right, that is that. So that is when there is always a cash generated from the new issue of shares. All right, so that is that. Let's go ahead and tackle the second one under basic EPS. And here we are looking at bonus issue. All right, when is it's a bonus issue? Remember, our bonus issue is also called capitalization. So if you don't see bonus issue, that is that. The firm is actually buying shares or giving shares out, all right, without taking any bonus. They are using retained earnings to actually buy shares, all right. It is called capitalization issue. It is also called scrip issue. All right, so take note of that. Whichever one you find, it means the same. Now, the characteristics of bonus issue you will see is that, number one, there is no additional resources to the issuer. I mean, it is a bonus issue and you don't get any money for it. All right, it's bonus. You don't get any money for it. So we say that the characteristics of bonus issue is that it does not provide additional resources. It does not, I cannot omit the not, it does not provide additional resources to the issuer. All right, the one who issued the bonus issue doesn't actually get any additional resource. There is no introduction of cash. That is what we need. Okay. And the second thing, characteristics you need to know is that when there is a bonus issue, the shareholders own the same proportion of the business before and after the issue. All right. That is it. Your position doesn't change. So if you are a shareholder before and after the bonus issue, we say that you will continue to own, shareholder owns the same proportion. The same proportion of the business. Before and after the bonus issue. All right, so probably your shares will increase, but I mean, you still have the same proportion. Now, what we need to do is that when we are calculating the basic EPS, therefore, what we need to know is that in the current year, the bonus shares are deemed to have been at start, all right? So we say that bonus shares is assumed to be at, assumed to be at start of the year. What this is trying to communicate to us is that there is no proportionate dealing of shares. So like the way at full market, we had to weight it using the date. Here, we are not interested in it. We are not interested in it. We assume that anytime the bonus issue was made, it was actually in existence even at the beginning of the period. So the same number of shares will be there. You don't need to wait it 6 months, 6 months. You assume that it has been there since the beginning. So it is there full year, regardless of the date the bonus issue was done. All right, please take note of that. Once we go through and use that to calculate our basic EPS, the next thing we need to do is that we need to actually restate the comparatives. All right, you have to restate the comparative. All right, as in you compare to last year, how it was, all right, or the existing basic earnings per share that was there at full market before, all right. Now, if you are going to go through and do this, then you need to go through and find what we call bonus fraction, okay? You need to find what we call bonus fraction. Because if you find your bonus fraction and you are doing your comparatives, you are going to actually do the inverse of your bonus fraction to apply it on the full market price, all right, to actually know how the effect is like, all right. So that is that. Minute. So you state your comparison. comparatives by applying the inverse of your bonus fraction. We need to go through the notes and you could see what we mean by bonus fraction. So bonus fraction herein is this what you see here. It is the number of ordinary shares after the number of shares after divided by the number of shares before. All right. So that is that. After over before. After over before. That is why we say that you use it for the EPS for the comparative years must be restated. All right. It is very, very important. Very, very important. So we say that if an entity makes a bonus issue of shares, then the share capital will increase. Yes, it's true, because the number of shares will have to increase. All right. However, like I pointed out earlier, no cash will be received, and therefore there is no impact on the earnings. All right. That is that. So this means that your denominator is going to increase. So what you see here is that if you have 1,000 and you are dividing it by 4, you always get 2,500. But if your 1,000 is not impacted or changed, and you now increase your denominator, you will realize that you will have what? It's 250 and 200. All right, so that is it. So the higher your denominator is growing, okay, the lower your results. All right, so what is going to happen here is that since there has been bonus share without any corresponding increase in cash or your earnings, what is going to happen is that your basic EPS will reduce. All right, so that is that. And we say that in calculating basic EPS, the bonus issue of share are treated as if they are always in existence. They are always been in issue. This is very, very important. All right. So thus you have to multiply the number of ordinary shares outstanding before the bonus issue by the bonus fraction. All right. So that is that. That is that. All right. Let's go ahead and look at how the computations look like by taking some examples. So when there is a bonus issue, you need to bring in what we call bonus fraction. Bonus fraction is the number of shares after the bonus issue divided by the number of shares before the bonus issue. All right, so that is that. But remember, you are going to restate it. All right, and that is the please note that it's very, very important. Note that. So let's see how the figures look like. All right, so given the same situation that we had earlier, the question is telling us that we should calculate basic EPS as at 2018. Okay, so what we need to go through and do is that it was 1 million in 2017. If we need to go through, we've not been told. What we have here is that the entity made a bonus issue of 1 for every 5 shares. So for every 5 shares that you have, all right, you are going to get 1 in addition. Okay, so that one will help us determine our bonus fraction. That is what it will help us determine our bonus fraction. So if you are going to go through and solve this question, what we need to do is first go ahead and deal with our EPS for 2017. All right, we will do 2017 down for the comparatives, but let's finish our 2018 that we need to do. Now, remember, when it is a bonus issue, you don't need to wait anything. All right, you just have to go ahead and just treat the shares as if the bonus issue was in existence even before the beginning of the year. So what we just need to do is to take our 2018 and do our basic EPS. 2018 basic EPS, therefore, is profit attributable to ordinary shareholders divided by the weighted average number of shares. So what is our profit? Our profit is simple. We have 550,000. What is the weighted average number of ordinary shares? It was 1 million, but there was a bonus issue you could see on this date. But here we are not interested in the weighting. Okay, so we can just go straight and slot it in. Which at the end of the day is giving us what? We have 45.8. All right, per share. That is what we have. We now need to go through and tackle the B part of the question. That says that we should calculate the prior year comparative EPS as it would appear in the financial statement over here. Remember, we need to find our bonus fraction. And like I said, you find your bonus fraction and you need to take the EPS of the previous year and multiply it by the inverse of your bonus fraction. If we wanted to do 2017, which we had to do, is straight away 460,000. Yeah, and we need to divide it by 1 million. Now, if you do 460 over 1 million, what you're going to get is that you are going to get, take these ones off. What you're going to get, I have here 0.46. So in a sense, what I'm having here is 46 pesos. All right, 46 or 46, 0.46 Ghana cedis. All right, so that is what I have here. Now, what we say that if they want us to restate, and this one, even when the question doesn't say, I mean, it's good you show it off. All right, show it off. So we need to now get our bonus fraction. Remember bonus fraction? Bonus fraction. Remember, it is the shares after bonus issue over the number of shares that existed before. All right, before. You can straight away find this one by looking at this you have here. All right. You can straight away go ahead and use that. Okay, that is what you can do. So if you are to go through with that, what is going to happen is that what you see that the bonus issue was for 1 for every 5 shares. So it means that before you have 5 shares, and now before you have 5 shares, and after you are going to end up having 6 shares. All right. So that is what because you have 1 in addition for every new share. All right. So you take note of that. Okay. So what is going to happen here is that even you can see from here that you have $1.2 million divided by 1 million. That is the after over the before, which gives you what? 6 over 5. In the same way, you saw that they made a bonus issue 1 for every 5 shares. All right. So it means that for every 5 shares that you had, you are going to get an additional 1. So it means that after or you will have 6 and before you have 5. So that is your bonus fraction. Now, we said that if you want to restate your comparative, you need to now multiply the reverse or the inverse of the bonus fraction. Inverse of the bonus fraction herein is what? 5/6. We need to take this inverse of the bonus fraction and multiply it by the previous years, all right, which we had 0.46. And that is going to actually give us 0.383, or you can say 38.3 pesos. All right, so you can actually state it like this. You could see clearly that if we are to compare what we have here, it gives us, we had 45.8 pesos, and you see the comparative that has been stated alongside it. All right, it's as simple as that. So when there is a bonus issue, do your bonus fraction. That's all. That's all. Do your bonus fraction. You don't need to set up the table to weight your ordinary number of shares in issue because there is no cash introduction. So all you need to do is to straight away pick the figures in the respective year, go ahead and do it. Do same for the 2017. But if you have to restate it, then you have to multiply your 2017 by the inverse of your bonus fraction. Remember, bonus fraction is given by the number of shares after the bonus issue or divided by the number of shares before the bonus issue. All right, so that is what. All right. So it's as cool as that. Very, very cool. So the bonus fraction, you realize that is the number of shares after bonus issue or divided by number of shares before bonus issue. All right, so that is that. Now, remember, we said that you are going to apply the inverse. All right, so you apply the inverse of this, okay, the inverse of this over the basic EPS that existed before the issue. All right, so that is that. Let's take another example. All right, let's look at Pep Rangers. For those of you who don't know Pep Rangers, that's the assistant coach of Liverpool. All right, Jurgen Klopp's deputy. All right, so Pep Rangers has 400,000 shares in issue until September 2014. It made a bonus issue of 100,000. Well, when it's a bonus issue, we don't actually care the date that. Right. Then it says that we should calculate the basic EPS for 2012 and the corresponding figure for 2021 if the earnings were 80,000 in 2012 and the EPS for 2011 is given to us. The company's accounting year is from January to 31st December, and we have been given all the information that I know you can see some glimpses of solution, but let's look at. If you want to calculate our 2012 basic EPS, remember, we need to just go ahead and slot it in. We are not really interested in the date because it was a bonus issue. All right, so that is that. It was a bonus issue. So all we need to do is to act as if the bonus issue existed, all right, even before. Okay, so what we need to do, they said that they had this until this, they add. So our shares here should actually be what? 500,000 at the end of the year. All right. So that is that. And we had this thing up to September and they had added a new one, but we are assuming that it already existed during the period. So that is what is going to happen. And so we actually need to go on and take our earnings of 80,000 and we have to divide it by our. If you put this on your calculator, what are you going to get? You are going to get 80,500. What I have here is 0.6 Ghana cedis. All right, so that is what you have. We are meant to check with the corresponding figure. Remember, if you want to go through and restate your comparative, you already have EPS for 2011 to be this, but we need to multiply it by the inverse of the bonus fraction. So what is the bonus fraction? We now need to determine our bonus fraction. All right, and we say bonus fraction is the number of shares that existed after, which is 500,000, divided by the number of shares that existed before, which is 400,000 for the bonus issue. What we're going to go through and do is you have 5/4. We now need to multiply the inverse of this by the comparative EPS that existed. So it's now be 4/5 multiplied by 0.185. So you have 4/5 multiplied by 0.185. And that will help us realize that if we are to restate this one into 2018, why are we restating? We are restating because we said that in bonus issue, we assume that the shares has already been in issue all along, all right, even from last year. Okay, so that is that. So now you have 0.148. So if you are to restate your opening retained earnings per share, then this is what it is going to look. All right, so that is that. It's as simple as that when it is a bonus issue. Very, very simple. Now, we now need to go ahead and look at when there is a right issue so that we finish off with basic EPS. All right, so key understanding. Let's look at right issue. What are we told? When there is a right issue actually combines, the full market concept and the bonus issue. So it means that you will have to bring from the full market the weighting. So you will have to draw our weighted average table where we have the actual our fraction and probability bonus. Right. So you need to take note of that. All right. So that is what you need to do. For the fact that there's a full market, you need to bring your table. All right. And because there is insertion of bonus issue will bring in the concept of bonus fraction. All right. And this one will bring in the concept of the fractions for the year. All right. So what you would realize is that if you are setting up your table, this is how it will look like. So you have number 3, we are talking about right issue. So we say that in the right issue, what is going to happen is that the characteristics you see in here is that number 1, they contribute for additional resource. All right, right issue is just the issue that you make, and you make those issues. It's just that it is not done at the same price. All right, it is given to you at a very reduced price. All right, so that is that. That is that. All right. So you need to go through and understand that. Then another characteristic is that, like I mentioned, the shares are actually priced below the market price. Below the market price. And we are talking about the full market price. So that is what happens. Okay, that is what happens. Please take note of that. All right, so because cash is coming in, there's introduction of new resource. You will have to set up your simple table. All right, you say, I'll show you how you set up your table. So, and like I said, this one combines full market and bonus issue. So you realize that when we are doing full market, we actually set our table with our dates. We talk about the actual number of shares. And we have our fraction of the year. All right, so if it is 6 months it lasted, that is what happens in a full market. Because this one combines the full market with the bonus issue, we will have to introduce here a bonus fraction. Bonus fraction. All right, so that is what happens. Okay, so at the end of the day, you will now have your table set there for your total number of shares, the weighted average number of shares. All right, so that is what you have. Okay. And key bit you need to understand is that if you are dealing, therefore, for the basic EPS, you need to go through and adjust both the earnings and also the weighted average. Okay, you need to adjust the earnings and you need to adjust the weighted average. You adjust your earnings by going through some steps, and you also adjust your fraction. Okay, so there is a typical 4-step approach when you are doing a right issue. Okay, 2 from the full market, 2 from what the bonus issue. So you bring it together, you go through a 4-step approach. Now let's go back to the class note. Let me show you these 4 steps. Now, like I've explained, to you, this is right issue. So you can see the characteristics as stated here. All right, you can see the characteristics are stated here at below the current market price. All right. So we say that the right issue now therefore combines the characteristics of the full market with the bonus issue. All right, so that is what you see. Now, what you need to go through and do is therefore calculate your bonus fraction. That is your step one. All right, you calculate your bonus fraction. And what do? You apply this on all outstanding share before the right issue. Bonus fraction in a right issue is different from the one in the bonus fraction only. It's different. Please take notes of that. Very different. Now, how different is it? You're going to get it by doing the market price of the share before. You remember when we are doing the bonus issue, it was after the bonus issue. This one, it is before the market price, before. That one was number of shares. This one is price. So here is market price before the right issue. Then when you go through and get that, you now need to divide it by your theoretical market price per share after the right issue. So market price per share after your right issue. All right, so that is that. And if you are to restate comparative, it's the same. Here too, you multiply it by what? The inverse. All right, you multiply your comparative by the inverse of your bonus fraction. And this is the bonus fraction we are talking about. All right, so that is that. That is that. Okay, so it means that from this step, what we need to find here is our theoretical X market price. Let's say. All right, so we said that the theoretical X market price, which is the TEP, is given by dividing the total. So this side, you need to work it too. You have the total value, that is the previous shares held, plus the new one that is brought at the right issue price, all right, of the shares. So for example, we see this example here. All right. So this example says, for example, if there is one for every 3 shares for 3 cedis, and the market price before was 5 cedis, then how do we get our theoretical X price? So you see, it's 1 for every 4 shares. So it means if you have 3 shares, you have 1 in addition, making 4. All right, you need to understand that. And you have the market price before to be 5 cedis. All right. Now remember, we say if you want our bonus fraction, we said that it was the market price, what? Before, all right, right issue, divided by the theoretical X right price after right issue. Now, what we need to look for is this step, and we are told that we need to go through this to find the step. All right, so what you see here is that, so you see before you have 3 shares, as you see here, and these 3 shares, the prices was 5 cedis, as you see here. So you need to go through and multiply your 3 by 5, and you will get what? 15 cedis. All right. Now, they now brought in this one new share at 3 cedis. That is the price here. That one new share will be at 3 cedis. All right. So they said that if you have 3 shares, you have additional one, which is pricing at 3 cedis. Don't forget, we said in the characteristics that the right issue price is always lower than what? The market price. That is why you see very lower. It's 5, it's full market is 5, right issue is 3. So what you need to go through is that one new share will now come in at a price of 3. If you now multiply that one, you are going to get this figure. So in a sense, whoever is involved in the right issue will now be having 4 shares. And the total price that he used will be what? 18. Now the theoretical X price herein is where you will have to take your 18, okay, and divide it by your 4. All right. And that is going to give you 4.5. That is how you find your X right price. All right, right issue price. That is how you find. Now, if you have this one, then it means you found your denominator. Your bonus fraction now can go ahead and be found by doing 5 over 4.5. So this gives you your bonus fraction. Remember the table we set up? That is the fraction that you are going to use there. All right. So that is that. So this is how you find your theoretical X left or X right issue. It's very easy. It's procedural. You need to just go through the process letter by letter. Is that understood? All right. So thank you very much. Thank you very much. So this is what we do concerning the bonus fraction. This is what we do to determine the bonus fraction. Let's move on. So since we've been able to determine our bonus fraction, and therefore we can use our bonus fraction to set up the table that we've seen here. All right, the table. So we can now slot in our bonus fraction as you can see here. All right. Okay, it's very, very important for the right issue. All right, so that is how it is. Okay, so we found our bonus fraction. That is how we work. Now, let's now go ahead and look at some examples. We said that the step 2 you need to do is to weight your weighted average number of connections. All right, so what we've done is that we've actually combined 2 steps where we are actually calculating our theoretical XREF and also finding our bonus fraction. So we've combined those 2 steps. The next step that we need to do here is to actually go ahead and now find the weighted average, right, number of ordinary shares. Okay, once we have that, we can now step into doing our earnings per share. All right. So as simple as that, that is what you need to do. We're going to use this illustration to demonstrate how this looks like. Okay. All right. So from the illustration that we have here, if you are going to do our weighted average, like I said, don't forget, you are going to draw your table. You draw up your usual table. All right, the table that I show you. All right. But when you are doing the table, like I said, there is an introduction of bonus fraction, which will be applied from the start of the year up to the date of the right issue. Please, it's very, very important. Up to the date of the right issue. Please, it doesn't go beyond the right issue, the date of the right issue. It's up to the date, please. Up to the date of the right issue. Please, these parts are the most important key places when we bring it on board. You need to take note of. All right, we said it is up to the date That is something that should stick into your mind. And that is what your examination will test. All right, so please be careful. Be careful. All right. So let's move ahead with the illustration that is before us. All right, this is the illustration that we have before us. An entity has one share, has issued one share for every two. One for every two. So it means if you have two, you get one. And the price of that one share that is coming in is what? 1 cedi, 50 pesos. And they did this on July 2018. July 2018. Right? What we are supposed to go through and understand is that we are given a pre-market issue of 3 cedis. Remember, we will need to find our bonus fraction. And our bonus fraction, we need to find our TEP, all right? So you need to, it's just procedural, all right? Just procedural. All right. Then we have this information as usual. Dates are key, all right? And the question said that we should calculate the EPS for 2018, all right? And it goes ahead that we should state comparative. So if you are solving the A part, remember there was a right issue, all right? Below the market price, you could see it's below the market. Now, what you need to do is to first calculate what? Your theoretical X-ray price. Why are you doing that? Because you need the bonus fraction, which you apply it in your table up to the date of the right issue, which we know bonus fraction here in the right issue is given by the market price before right issue all over the tab that we are going to look for. And that is where we are. Now, if you need to go and find our tab, we need to now go through the analysis that we always do. Before, what was there? We had 2 shares, and the 2 shares was how much? 3 cedis. So it means that what we go through is that we will be having 3 cedis. That is what we have to get our 6 Ghana cedis. All right. Then there was a taking up of new right shares, which was 1, and that one came in by how much? It is 1 cedi 50 pesos. So that one gives us 1.5. Now, what we need to understand is that at the end of the day, whoever took it up will have 3 shares, and their full money will now be what? 7.5. Okay, now we need to go through and do 7.5 all over 3, and that one will give us our third. All right, that one will give us our third. If you now do 7.5 over 3, and what you get in is what? 2.5. Okay, so we now can finish up our bonus fraction by going ahead. The price before was given to us as 3. And we now have our third to be what? 2.5. This gives us our bonus fraction. Right. Since we have our bonus fraction, we need to go on and calculate our weighted average number of shares. And we said that to be able to do that, we need to set up our table. So let's go to our table. All right, so here is our table. We now need to follow suit and go ahead. So we see that as of January 1, 2018, the brought forward of number of shares, you could see from the question coming from 2018, all right, 2017 is what, 800,000. And at the end, it ended up being what, 200,000, because there was a right issue, all right. So it means that if you had, for example, what they were telling us is that for every 2 shares that you have existing here, you got additional share. So if you now need to go through and do this, you will have what, 400,000. All right, that is what you have. If this 400,000 comes to add up to the 800, that is where we ended up having this 1.2. All right, so that is the right issue that came up. Now let's set up our table as we see here. So we had in our opening, we had 800. All right, and mind you, the bonus issue happened in the middle, and so the fraction for the year was what, 6/4. Now remember, we have to apply the bonus fraction we calculated for from the year up to the date. All right, up to the date of the bonus fraction. Okay, so what is going to happen here is that we need to now put in our bonus fraction, which is 3/2.5. All right, that is what. So here, if you go through to do these multiplications, what we are going to end up is what? All right, what you're going to get here is I have 480,000. So that is that. We now need to go through and bring in what our right issue that was made. Right issue, which per the calculation that I showed you there was what, 400,000. And that one means that as at 1st July 2018, we had 1,002. And this 1,002 was spent was 6 months. Do we need to bring the bonus fraction? No. Why? Because we apply it up to the date. All right, so that is what we have done. So we don't need to bring it. So the date the bonus fraction happened, you don't need to apply. The date the right issue happened, you don't need to apply the bonus fraction. So that is all. So we multiply this one. Easy chop is what, 600. We now need to find the total of this, which will give us what, 1,080. 180. Here, easy. We now need to come here and pick up our 2018 basic EPS. What was our earnings? What was our earnings? Earnings was 550. All right, then we already have our weighted average number of ordinary shares. So we now need to go back and slot in our 550,000 over the weighted average of number of ordinary shares, which is 1087. And that gives us what? I think it gives me 0.509. It is in monetary terms, so I can say it's 0.51 per share. All right, so that is it. That is it. All right. So that is all. We now need to restate our comparative, which is the B part of the question. In the comparative, we need to find the EPS for that particular year and multiply by the inverse of this bonus fraction. All right. So what we need to go through and do is to find what was here. Here is straightforward. You take 460 you divide it by your 800,000, and that one is easy. Okay, 460, 800 gives me 0.575 or 0.58. All right, we now need to multiply it by the inverse. All right, so keep this figure in your head as we go to our screen. So what happens is that we actually did EPS for that year being 460,000 all over what? 800,000. We are just multiplying it straight away by the inverse of our bonus fraction. And that one is what? 2.5 all over. At the end of the day, that one ends up as with 0.479. So you can say 0.548, sorry. I'll go on, so 0.48 per share. So that is our comparatives. Okay, so that is that. I don't think it's that much difficult. You need to keep practicing and you will be there. All right, so let's see, go back to our notes. This one was dealt with easy peasy. There is an interesting question for you to attempt. I think this question, we can see what we have here. All right, so this question is in isolations. You have 30th June, that is where they prepare the account to. And you have 1st July. They are having this. So 30th June for the previous year, and next year will give you this. So they said that you have 5 million ordinary share in issue, and you are given this information. It says that share capital was not changed. If it is not changed, then what we need to go through is to use our 250 million and divide by our 500,000 as if nothing happened. So it's as simple as that. It's as simple as that. So this one, what will happen is that the A part is simple. You just pick your 250 million divided by what? 500 million. Okay, so let's see, 250, 500. Okay, so it means that you have 0.5 per share. You are done. Now they tell you that there was a right issue. You are treating it in isolation. Okay. In case they give it to you in one full case story, and then it means that you need to treat them as if they all happened in the new year. But because they are asking us to do it A, B, C, it's simple. All you need to go through and do is as full market. It means you need to wait your date. So you can say that it was 500 million as at the beginning. So you say July 2015, you are waiting your ordinary share. This is just to guide you. So you had that one having 5 million. And when was the new issue? August. So you count July, August. So it means that this one was just 1 month. So 1/12. All right, get it, you put it there. And the new issue that came in was how much? 50 million. So it means that you have 550 as at when from August 2015. And that one is obviously what, 11 months. All right, so you weight it, you use it to get your weighted average. Your profit didn't change. So you go ahead and do it. Okay, and if there is bonus issue, you don't need to wait any date. So you just pick your 250 and assume that the bonus issue was there. So what you need to do is that you already have 500 as at this date. But the bonus issue, we don't mind. We say that you should treat it as if it existed. So what is going to happen is that they said for every 4 that you have, all right, you are going to get 1 in addition. So this one just makes 1/4. If you're having difficulty to read this, what you need to do is that they had 5 million. All right, so for every 4 out of this, you are going to get an additional 1. All right, so what is going to happen is that if you do this multiply by 500 million, like this one you have, what you're going to get is that you have 500 divided by 4 multiplied by 1. It means that there was the new introduction was what, 125. So after, you will see that you have how much? 625. Okay, that is your number. So you are taking your 250 over 625. You need to get your bonus fraction, correct? So bonus fraction is after divided by before. So you see that after you had this and before it was this. So that one will give you your bonus fraction. All right, so you have 625, you divide it by 500. Bonus fraction is what? 1.25. You can maintain your fraction as it is, or you can convert it. So what is going to happen to this? If you are to reinstate, then you are going to pick the answer that you have already here and multiply it by 8. It's as simple as that. All right. I think there should be right issue. Yeah, there was right issue. That one is easy peasy. You just need to go through the steps. It's nothing difficult, right? You need to discipline yourself and go through the steps. And remember, you will have to set up your table, all right? So what we said was that you need to find your tab, use your tab to find your bonus fraction and go ahead and calculate your EPS. If you are supposed to find out, they said for every 1, a 1 for every 5 right issue held at this and the market price before is this. I mean, all you need to do is that when we had 5, the price was what? 1.4. And that should give us how much? That should give us 5 by 1.4, which is 7. And the one that came in is coming at a price of what? 1.2. So you have 1.25 like this. At the end of the day, it's what? 8.25. Whoever subscribed it is having now 8 shares. Bonus fraction, this you have to finish it off by doing 8.25 divided by what? 6. And that is going to give us what? 1.375. Our bonus fraction, we need to go through and do what is the price before? It's 1.4. What is the theoretical X price, which we found? 1.375. This gives us our bonus fraction. We now need to set up our table. You have your date, you have your number of shares, you have your year fraction. All right. If you want to bring bonus issue, then you have your weighted average. All right. If this question is all into together, but if they want us to treat this separate as if the rest, as if this side did not exist, then we are good to go. All we need to do is to take the shares that existed. Like for instance, we're going to take all the shares that was existing before. I think it was 5 million as at what? The beginning of the year. And February, they brought in new one. So this one, what do we do? How many months? So we had January, July, August, September, October, November, December, January. All right, that is 7 months. That is what it lasted. Okay. If we need to treat this thing as a whole, then we've had our bonus fraction, which is what 1.40 over what 1.375. You will slot it in there. You now need to bring in your 1st February 2016. And what is the right issue? They said that 1 for every 5. So you could see clearly that if you had 5 million and they said 1 for every 5, this is how it's going to be. Then it means that they brought in additional 100 million, all right, which will 100 million, which when you add up will give you how much? 600 million. And this one will last for, all right, you don't need to apply the bonus fraction as we all know, because it is applied up to. All right, so that is that. If you need to go through and solve this question, you now have to multiply your 500 by your 12 out of 12 months. You multiply by 1.4 divided by 1.375. All right, so what you're going to get, when I round it up, I'm having 297. I need to go through and do the same for this side, multiply by 1/6. What I'm getting here. So I have 5/12, I have 1 million, 6 million, 600 million, 100 million. What I'm getting here, I'm having something like 0. So if I need to multiply this, what I'm actually getting is 0. So it's 1, 6. Yeah, they are in millions. So this one is actually in million. 1, 6 multiplied by 5/12. Yeah. So what I'm actually getting here is 0.6069 million. You can actually round it up and make it 0.7 if you want million. All right. If I need to add this one up, what is going to happen? Let me just erase, make it more professional. All right. So what I'm having is 0.0. If I round it up, it will be 0.7 million. All right, so that is what I have. 0.07 plus 297. Okay, and that gives me 297.07. So that is when you are bringing everything together. You can now go ahead and pick your 250. So basic EPS will now be your 250 all over your 297.07. All right, so 250 divided by this answer will now give me what? It is giving me 0.841 or 0.84 per share. All right, so that is how it goes. Don't forget, we now need to multiply whatever we had for the basic EPS. Where are you? This one. By the inverse, okay? If you had some for last year, you multiply by. I don't think we had anything for last year. So we are good to go. By the inverse, had it been that, we will need to multiply it by the inverse. All right, so that is that. So that ends our discussion under basic EPS. So you see that I've actually done a table that describes how you set up your date in terms of right issue. All right, so this is how the table looks like. it's important you go through this, because when you get to corporate reporting, if they are testing you, they will have to bring everything together. Like you see here, so you have to draw your table. So what is happening in this table is that you bring the brought forward, the number of shares brought forward, you weight it up to the number of months, you apply your TEP, all right, and your bonus fraction. Okay, so you can actually do this one inside this. Okay, so you might not need to even bring your TEP. All right, so you can take off the TEP, maintain your bonus fraction. All right, so that is that. The same thing you apply it through here. When it gets to the right issue, you can only apply the bonus fraction, not the one of, so you see that your TEP is not applicable here. That bonus, that particular one is not applicable. I mean, this one is the bonus fraction coming from the right issue. All right, so I mean, it depends on the question. If you have everything inside, arrange full market, apply the bonus fraction from right issue. Also apply bonus fraction from where? Your normal bonus fraction. All right, at full market. Okay, full market, you may not have so plenty to do with. So you apply your right issue. Here, right issue, your right bonus fraction from right issue is not applicable. You only apply the bonus fraction from the normal bonus issue. All right. So when it comes to here, it's not applicable here. Here too, the bonus fraction is applied up to the time, all right, of the bonus issue. So that in the examples that we did. So that is that. The next thing we need to go through and do is basic diluted earnings per share. But I would want to end this one here so that we carry on with the diluted and the options in our next lecture. All right. So see you guys